Good afternoon, everyone. Warren Buffett, the CEO of Berkshire Hathaway and one of the most astute value investors, has just two simple rules with investing. Rule number one, never lose money. And rule number two, never forget rule number one. Now, in theory, in concept, that seems quite straightforward, but in practice, it's extremely, extremely difficult. Now, if I was here today 10 years ago and presenting to all of you, my advice would be quite straightforward. Cash is king. Hold on to your bricks and mortar. Load up the truck and put as much money into superannuation as possible. And if you were to invest in shares that Alberto was alluding to, or risk assets, then you would need to get a minimum return of 7%. And that's the minimum return that you would accept, but that's the minimum return you would even get out of bed for before you even start analysing the risk-reward trade-off. Now, fast forward to today. What's changed? What's happened? We've gone through a big structural shift. There's been a convergence of technologies, sectors, big companies that are becoming extremely dominant. Just look at the US market. The FANG stocks, Facebook, Amazon, Apple, Netflix, Google, they actually account for 15% of the S&P 500 index over there. And you look at Australia, it's only 2% of the global market. Also, with regards to legislative and tax reform, which is ever changing, and you look at the landscape, superannuation, you have limits on how much money you can actually hold in retirement phase, how much money you can hold in pension phase, and actually the limits of actually getting money into superannuation has also become something that's quite challenging and something that you need to keep your advice being fluid and reflective of current circumstances. Now, if you look at planning for retirement for yourselves, and I'm not actually saying, geez, you should retire tomorrow. I'm not premising that at all. But what I am saying is take action now, take decisive action now, so you've got the optionality around what you do when you do retire. Some of the things that we'll look at when you do start looking at retirement and getting into that phase, you've got a lot less appetite for debt restructuring, servicing your debts. Your private practice that you've set up is maturing. You're producing high quality revenue and you're starting to consider succession planning and potential sale of that asset. Your children are getting a lot less financially dependent on you. I'm sure some of you can recognize that. And in terms of what you value, things will change with that as well. Some of the things I'm going to walk through today around superannuation, we did go through accumulation phase, but also the concessions around pension phase and the importance of that. Go through portfolio construction and retirement, which can at times look completely different to what you're doing when you're in accumulation phase. And also just around business planning and some of the concessions available to you. Now, as I was saying, getting into wealth consumption phase. So no longer are you in your peak earnings. You've built your asset base, you've got it across your entities, you've got the right assets, you've validated them. And now you're thinking about, well, what passive income can I derive from these assets? And there are risks that are very different to what you have when you're in accumulation phase. Three of the key risks that we'll look at will be inflation, your purchasing power, the price of goods and services are rising. Is your portfolio positioned for that? Longevity, everyone is living longer. You're specialists in this field, it is a linear curve up. Are you going to outlive your capital or are you going to spend too much and then be reliant on other assets? And then sequencing risk, which is extremely important as well. So as you get more and more down your career, your appreciation for losses or capital losses become more and more important. So you want to make sure you're positioned for that. And what I will say is, if you do have various entities, most of the time you will have different investment strategies and time horizons that sit around that. We'll look at that. So you've seen this before. Alberto went through it in quite a lot of detail, but really the focus here is around this middle section here. And what I will say is the discussion and the case studies that I look at is from a lens of financially successful doctors and specialists that we've worked with that have done really well in this space. So when you focus more on this side, on contributions, yes, you get contributions in, you're capped on your 25K personal deduction, but by this time you've got assets that sit in each of these entities. And the other thing that you can do is start putting in after-tax contributions. An after-tax contribution is currently capped at $100,000. You can also bring forward 3 years worth of after-tax contributions, so $300K in 3 years. But what I will say is, and one of the nuances, which you may have picked up on the slides, is that $1.6 million cap versus 1.7. Now, these numbers are actually indexed. So about a month ago, the indexation numbers came out. And what that means is these numbers will move every year and you need to be across that. So from 1 July this year, that $25,000 turns into $27,500. That $100,000 turns into $110,000. And these are things that you need to consider on an ongoing basis. Now, really for everyone, the minimum that you should be targeting in your superannuation is $1.6 million as a baseline. As a bare baseline, that's what you should be targeting. And you can see as things flow through, once you get to a point where you meet a condition of release, either meeting preservation age, which is generally 65 and you permanently retire, or you meet a condition of release being preservation age and you want to set up a transition to retirement. The other two are death and disability, but generally it's around preservation age that we want to plan for here. And at that point, you can actually access your superannuation and set up what's called an account-based pension. Now, the whole design of superannuation, the reason you look at a lot of these tax reform changes that come through and you go, well, let's look at it from the lens of government. The reason why superannuation is set up is they don't want people on Social Security, they want self-funded retirees. And to encourage people to contribute into superannuation, they're more than willing to provide concessional rates and different concessions available to promote for you to become self-funded retirees. So if you get to that point where you start setting up an account-based pension, $1.6 million, you're essentially not paying any income tax and any capital gains tax. And the money that you draw from that is actually zero tax as well. Now, the government says you're more than happy to have 0% tax rate in that environment, but in order to do that, you must take a minimum out each year, and there's a maximum as well. So this is extremely important. Now, the reason why I was alluding to history 10 years ago to now, things constantly change. Prior to this, back in 1980s, 1990s, there weren't any caps in pension phase. So what do you think good advisors and good accountants advise their clients of? Putting as much money into this as possible, because it's a zero tax environment. So when you start, whether you're starting off or you're accumulating your assets or you're getting to that point where you're thinking about starting to draw income, you really need to be thinking about where are my assets, what entities are they in, what are the caps, and what kind of strategy planning can I do to put as much money in there as possible. And you should be thinking about that every financial year and what plans that you've got to do that. And I suppose the other thing to mention as well with regards to contributions, and it really depends on what superannuation vehicle you have, it's not necessarily just a cash contribution that you can put across. You can also transfer shares, you can transfer other assets, and that's extremely important. And you need to consider CGT on that, but obviously these are things you need to work through with your advisor, and it's extremely important. I'll just keep going through. Actually, before I go on to the next slide, I suppose a quick example, something that's extremely important from a capital gains tax perspective. A lot of you will buy private practice rooms, and I'll just walk through a couple examples on that. Say you were to buy a practice room for $500,000, you bought it outright, and 12 months later you get it revalued and it's worth $1 million. You've held it for 12 months. That $500,000 capital gain, $250,000 of that would get disregarded. That other $250,000 will get added onto your marginal tax rate. You'd essentially lose half the value of that in tax, $125,000 in tax, not including any other personal exertion income that you've got. On another respect, on that same example, same numbers, you've got that practice room in superannuation. You haven't converted across to pension. It's in accumulation phase. You held it for 12 months and you sold it. You get 1/3 discount, so 33% discount. The rest would be fully assessable, so $166,000 of that would get disregarded. The remaining would get taxed at 15%. The next example, same numbers. Buy a practice room for $500,000, get it revalued a year later. you convert it to pension phase and you sold it, it would be on capital account. There would be no capital gains tax. You would get $1 million and you wouldn't pay any tax on that $500,000 capital gain. So you can see the beauty of that. And that example, obviously relevant for all of you, it applies to any asset that you've got in that environment. And even if you were to get to that minimum 1.6 and you had well over that, because in accumulation phase, you can have as much money as you want in there. 15% is pretty attractive. And even when you start going through these steps as well, on whether it's income at 15% or 1/3 capital gain discount on your assets, it's a very attractive proposition. You really should be positioning yourself right now, or as you move closer and closer to drawdown phase, to have as much assets in here as possible. And you should be working with your advisor to do so.
I'm sure you're probably going to cover this
Yeah.
as we go on.
Yep.
But, I mean, I accept what you're saying, and I know that that's good advice. But
Yep.
on the other end, you do have to be somewhat careful, kind of, with assets, right? Because you need to keep once you're drawing on your pension. If you've still got non-liquid assets in your scheme, right? Then you're going to actually have, even though because they're bricks and mortar, you're actually going to have to sell them in order to, have liquidity to keep drawing down, right?
Yeah, definitely. I mean, that's part of portfolio construction. So while you're working, buy a practice room, you can leverage up, you can buy it in superannuation, another entity. At some point, when you do need income, how much net yield do you actually get on that practice room or on a commercial property? We see this time and time again. It might get chewed up in capital works or maintenance or different things. So your accountant or your advisor should be actually analysing that asset every year and saying, well, what's it actually doing? If it's netting 2% yield, is that really worth having such a big lumpy asset in there? I mean, the analogy that Alberto...
Problem if you're diversified and you've got more than just that big lumpy asset in there. Yeah. This is the problem a lot of doctors, sorry.
Yeah, no, jump in, Steve.
A lot saying, oh, well, as early as possible, I'll put my rooms in there, and that's my superannuation fund. We've come across exactly this issue. Not enough liquidity to pay tax, not enough liquidity to draw down on pension phase, and you're breaking the greatest golden rule of investment, and that is diversify, diversify, diversify. If you want the best returns, you're going to have some money spread against a number of different asset classes: international shares, Australian shares, property, cash, fixed interest. Sorry.
No problems. Thanks, Steve. Yeah, I suppose the analogy they use is, diversification is the only free lunch in investing, and it definitely keeps you humble. But, the analogy that Alberto and I use is when people need to produce income because they've got minimum requirements that they need to meet, you can't sell a fridge, you can't sell a door, you can't sell certain fixed assets in there. It's a very lumpy asset. You need to consider liquidity when you're building out your portfolio. Keep going through. So these are some financial strategies that we've seen with clients that we work on, and these change every year. So right now, some of you are in accumulation phase, some of you are in pre-retirement planning phase, and some of you are actually in pre-retirement. These will change in some form or another. That is guaranteed. Legislation continually changes, tax reform changes. You need to be across these and working with your advisor very closely to apply them to your own circumstances. But things that you would start looking at would be, your lump sum tax contributions, your non-concessional amounts. So it's an after-tax contribution that you're putting into superannuation phase. You can do it as cash or as an asset. And from 1 July this year, it goes up to 110,000. And these are things that you need to be aware of to really maximize. Because the thing that you look at is when you get money into superannuation, it's very easy to take it out. You meet a condition of release, you meet preservation age, you're drawing down your minimum from your pension account, your accumulation account is fully accessible. You can take out as much money as you want, but the restrictions on getting money in there has been coming down over time. So as time gets on, there's less and less money you can get into superannuation, so you need to be aware of that. Bring forward rule I've discussed. You should be targeting, again, 1.7 million is per member within your family group. This is something that's really important, and it's not just across Medico, but it's also across a lot of other industries as well. You'll find that there'll be one member that will be earning more than the other spouse. your spouse. And generally what you find is with contributions, when you're in that peak earnings phase, is it's quite disproportionate. And you'll find that one accumulation, one member statement is going up a lot more than the other. So you should actually be looking at member equalising over time and making sure you can maximise that 1.7 per member and then reassess that. Another thing that you can look at as well is something quite common. Housing affordability has obviously been something very pertinent in Sydney and Melbourne, and we've seen it. There are some reforms coming through there. One of the most recent ones was around the downsizer contribution for your principal place of residence. So prior to that, people that had retired and they were too old, they couldn't put any more money into super. One of the concessions that the government introduced was downsizer. So if you had a principal place of residence that you had lived in for 10 years, you could sell that tax-free, and per member, you could put $300,000 into that superannuation account pending transfer balance cap. So these are things that you'll continually look at and see whether they apply to your circumstances or not. And I suppose an interesting thing on that, it's a 90-day window to get the money in once you get the proceeds from the sale of your principal place of residence. But the other thing is, even though it says downsize, that doesn't necessarily mean you can't sell your principal place of residence and buy something bigger. So you need to look at the nuances. So even though they maybe coined these certain terms, the actual technicality of them you need to look at and work with your advisor on them. Just some other things, minimum pension requirements I've covered off, but essentially as you get older, you're forced to take more and more from your superannuation account, and that's something you'll review on an ongoing basis. Income streaming via adult children and bucket company. I mean, we went through this with Alberto, but at some point with a large cash flow that you will get to, if you're not already there, you will build up other assets in different structures. So every end of financial year and prior, you should be working with your advisor to actually say, well, where are we distributing? What's the most tax effective way? Is it on capital account? Is it on income account? And what can we use? So as your kids tick over to age 18, you can start using them as beneficiaries, and you get out of that child high tax rate that applies if they're under age 18. This is something that you touched on just before, portfolio liquidity planning. So it's not just about rooms that you buy, but any illiquid asset that you buy. Tao was talking about property and buying in office trust. There are some types of investments where you've got lock-up periods, where your capital might actually be tied up for 10 years and you can't redeem that amount. You might be buying into a private business or certain things where you've got restrictions on actually redeeming that money. So these are the types of things you need to look at is, if something terrible occurred, how quick can I liquidate my portfolio and what kind of considerations do I need to take into account there? And that's extremely important. The other thing as well, which is really probably one of the biggest things, and I've put it as the last point, just around succession planning and a liquidity event. Liquidity event being the sale of your assets, being your private practice. Extremely important. I've seen very fruitful transactions, and there are concessions available there as well when you sell your business. Essentially, your maximum net asset value needs to be $6 million or under, and you need to be turning over $2 million or under. Essentially, the whole point around the concessions, there are 4 that you can apply to your circumstances, is bringing, when you sell that business, to bring it down to 0, so you're not paying any capital gains at all. And then there are some strategies on where you can allocate that, whether you put it into super or whether you take it into your personal name. But this is something that's extremely important. I suppose a very quick case study on that. One of our large clients that's out in the eastern suburbs owns a big practice. He grew that practice from 2 to 16 practitioners out there. That business, 40 years ago, he entered into a contract. He only owned 40% of that business. The other practitioner owned 60%. He was a minority shareholder in there and didn't have voting control. One of the things that the other practitioner said was, well, I don't want you to sell the business. I don't want you to sell your portion out. We're going to sell it internally. And he essentially sold a portion of his shares to another practitioner coming through, an equity partner, and it was at a very low valuation. So what we did was we had a third-party corporate come in and put in a high bid that essentially prompted up that value. So there's lots of things you need to look at, but it's really around getting your CGT position down as much as possible. Go through the next one. Another really good Warren Buffett quote is, you don't know who's swimming naked until the tide goes out. And It's very, very true in every single type of black swan event or big drawdown event, and we've seen many. The last three that I'll walk through, we had the dot-com crash in 2000 and 2001, we had the global financial crisis in 2008, 2009, and the big drawdown event that we're all across is COVID, essentially this time last year. And what we saw was mass hysteria from March. We saw this is essentially the ASX 200, so the top 200 companies in Australia, drew down from peak to trough 27% in 22 trading days. So essentially just over 3 weeks. And you can see during this period, some sectors were more impacted than others, but the common trait across any of these black swan events is there was indiscriminate selling. There's a big drawdown. No one knows when the bottom is. But I suppose looking at this lens versus some of the other big crises that we've had is the amount of stimulus and the coordinated central bank interaction to really buoy the economy and put those concessions in, the stimulus in the economy to really prompt it up and give it a buffer. Some of the things that you should be looking at, whether you're building a portfolio or even for your private practice, is contingency planning. So when these events do occur, what decisive action are you going to take? Whether it's in your business or whether it's in your actual portfolio. We personally had some clients that were buying aggressively in March. We had some clients that educated themselves more and started a master's degree. We had another one that started doing marketing videos for their private practice. Ask yourselves, what decisive action did you take during that COVID period when elective surgery was off, or if your business was impacted in some form or another? Very important. The other interesting thing as well is, some sectors were impacted more than others. Think about travel. We're not traveling overseas anytime soon. We don't know when we'll travel. Some sectors are impacted more than others, like I just said. The interesting thing is businesses actually came out a lot better than we anticipated. Every February, the ASX companies report their full year earnings, and analysts will have expectations on what they think they'll deliver. What we saw was businesses raise a lot of money. Businesses restructure their businesses and become a lot more leaner, a lot more cost efficient. And they actually came out, 56% of companies that we cover that reported actually beat expectations. So these companies, from the stimulus, from the sentiment, have done really well, which really showed you that V-shaped recovery in markets. Just some of the risks around when you transition in that peak period from building your assets to actually drawing down on your capital. Peak sequencing of returns risk. And what you can see I've got in the background there is $1 million portfolio. You're drawing down $5,000 per month. You've got investment returns of 5%. If you suffer a capital loss in year 1 versus a capital loss in year 5, it can actually really impact your portfolio. And the calculation we've got back in a spreadsheet is essentially 8 to 10 years of retirement income. So if you think about it, you're starting to draw down capital last year. We have a big drawdown, 27% drawdown in markets, and then you're taking money on top of that. You're actually amplifying the erosion of your capital base. So it's extremely important. Set and forget strategy doesn't cut it anymore. There's too much change happening. You need to be across it. Another big risk is just longevity risk. You don't want to outlive your capital. You want to have a plan in place. You don't want to be spending too much. You want to make sure that you've got enough asset base to fuel your income and requirements. This is really, really topical and interesting. So don't have the chart here, but if you look at government yields, the Australian government yields, they'd actually be going from top left to top right. Yields are coming down. Cash rates are at 10 basis points. Really, if you were holding cash right now and said, Matt, I'm not going to get any capital losses, I'm holding cash. Well, your purchasing power is actually getting eroded. So what we're seeing now with a lot of our clients that are in that retirement phase, or you should be speaking to your advisor around this, is not just looking at income when you're looking at your portfolio and the assets that sit within it, underneath it, but also capital growth and total return profile. Total return is your income plus your capital growth. Now, 2 hallmark companies that you would both know, CBA, the biggest bank in Australia, pretty much control the residential market, and CSL, which is a biopharmaceuticals company that produces and manufactures a whole raft of products. If you invest in both those companies, CBA attracts a 3% yield. CSL provides a yield of 1%. Over a 10-year period, you can see that the return profile is 178% on the blue line here, and CSL is 820% on the green line. So not just focusing on income, but looking at the broader composition of your portfolio, whether it's capital growth or income, and working around the edges is extremely important. I know which one I would want to be invested in over a full investment cycle. And just applying this back to the case study and some of the strategies that I would deploy for Sig and Martha, maximize your pre and post contributions into superannuation and bolster that portfolio as much as possible. If you think about tax structures, it's really just an entity that can hold assets with different tax application across them. Solidify your succession planning within your business. You know, the technical term that we use is key man risk within the business. You really want to de-risk away from that for your private practice. And you want to prepare your business to be sale ready. Think about the screening process that Alberto put on the wall. If someone approached you today and wanted to buy your business, what kind of metrics would they look at? And are you actually implementing that in your own practice? I'd set up in a case-bound pension for 1.6 now, 1.7 from 1 July for each member. Start drawing down. I'd utilise their adult children as beneficiaries for income streaming and tax splitting. The other thing is, if you haven't changed the insurances from the time that Phil set them up, you probably should look at that because they probably don't have debt anymore. So you really want to review the insurances on an ongoing basis, make sure they're fit for purpose. And the big, most interesting one that comes in a lot of different areas and facets is the portfolio, your investment portfolio across your structures. I consider the net yield of your assets. What are they actually doing for you and how are they contributing to the overall return profile of your portfolio? Are cash and fixed income assets actually reflective of the current macro environment we're in, or do you need to reposition it for what's happening right now? If you do have fixed income assets and you think rates will start moving up, should you be in floating rate notes that will start moving up as the interest rate cycle loosens? The other one would be, don't just focus on income generation. You hear a lot of Australian investors say, I want dividends, I want income. But you should look at both income and capital and franking credits. And the last one is really, do you revise your expectations down for a lower return, or do you step up the risk curve? And that's a conversation you should have with your advisors. Thank you.